Hello, everybody. Today we're going to be looking at what led to the Great Depression. I don't like to use the word cause typically in many ways, though, because I like to teach the Great Depression as almost like a disease that had symptoms. So, with that said, here are the key terms that we'll be looking at, and here is the reading from American Yup that corresponds. As always, I'll leave a note in the description below and in the cards in case you are not one of my students and you want to check out that book. Here are the questions that we want to answer during this lecture. So, typically, we want to look at major economic weaknesses that lead to the Great Depression. And then we also want to think about the response. So we're only going to get as far as the Hoover administration for today. We're going to move forward and look at Franklin Delano Roosevelt and the New Deal in a future video, so stay tuned for that. In any event, let's first look at what was going on in the 1920s. I think that there's a large misconception that the Great Depression started in 1929 with a market crash, but in many ways, particularly in rural America, we saw a lot of issues that maybe we should have seen the Great Depression coming a little bit more. All right, there were some symptoms. And so, in terms of agriculture, this is really a time when rural America is struggling. Um, so workers and farmers, they were very much struggling after the end of World War One because the demand for all these agricultural goods really plummets. The United States in many ways acted as a breadbasket for their allies in Europe in World War One, and once the European agricultural sector starts to recover, that need is no longer there. But farmers are still producing as much as they used to be in many areas. And what ultimately happens is that because the price of these goods declines so much along with demand, that farmers are unable to pay for their mortgages and pay for all the different supplies that they need to farm. We're also seeing that incomes in urban areas are increasing at a much higher rate. In fact, in many ways, agricultural incomes are actually plummeting. So that's a real issue as well. So it's not the roaring 20s in most rural areas in the United States. The South is also unique in the sense that they largely still demand cotton primarily as their crop, and it's a cash crop. It is not something that's going to feed that population. It is also saturating the market, and so that's a real problem in the South. And we'll continue looking at that when we talk about continued migration patterns from the South to other areas in the United States. And actually, before we get to Hoover, the Coolidge administration also does not really help because there actually literally were attempts to draft legislation in Congress, even though the Republican Party was dominating Congress in the 20s, to help regulate farm prices. And that bill, there was a bill called the McNary-Haugen bill. Forgive me if I'm mispronouncing that. And what that ultimately was trying to do was to stabilize the prices of agricultural goods, just like previous legislation in the late 19th century was attempting to stabilize and control railroad prices. But Calvin Coolidge vetoed that bill after it passed. It's important to realize just typically that the debts of farmers were something that was also tied explicitly to that free market approach that these three presidents in the 1920s emphasized. And wheat was the largest industry in the agricultural sector, but also the dairy and citrus industry greatly suffered in the 20s. And then it's also important for us to note that many farmers also are tenant farmers. They don't actually own their land. And when the prices plummet, that also leads to them oftentimes being kicked off that land and they have to move elsewhere for jobs. And when I say tenant farmers, I'm also including sharecropping here. There are other industries that are quite weak that are not agricultural, but also are quite common in rural America. So, the coal mining industry, for example, is facing increasing competition from oil and gas. And further, again, that decrease in pay in these sectors and the decrease in the number of available jobs for coal miners is going to cause a migration elsewhere. And that will also lead to ghost towns in some of these former mining towns. Railroads also suffer, and that's largely because cars become more affordable. So that's sort of starting this general sense that most parts of America are reliant on cars, right? We very much are still a car culture. And lastly, the New England textile industry, and this isn't really rural so much, but that industry as well. Very much struggles. And again, it's largely because wages are falling. And it's also because there is an increase in textile factories also in the South after the Civil War. And that's largely A, because prices are low, but B, because the federal government was attempting to make the Southern economy less reliant solely on cotton cultivation. But textiles, of course, are just still about cotton primarily, but they're about cotton manufacturing. But nonetheless, New England also suffers from that, the growth of that sector, since they typically cannot afford to operate as cheaply as these southern textile industries. One thing that I don't have included in my notes, but you see it on this slide, is this is also a time of culture war throughout the entire country. And in a previous video, I get into the rise of the KKK, and also just general rises of white supremacy in the 1920s. And so I'll leave a link to that in the cards so that I don't make this video too long. There isn't really much content to discuss in this slide, but if you want to just analyze these graphs and charts, if you want to really consider why this is significant, just think about this as data that could be useful for you, right? To what extent do we see these two graphs helping us understand why agriculture in the United States was suffering as much as it was? So let's actually move forward to what's going on in the stock market. And it's important also to note that the booming of the stock market in many ways was artificial. These stock prices were not necessarily growing at the same rate. They were growing much faster than the rate of the industries that those stocks had shares for. And this is really problematic. There's this general sense of economic optimism during the 20s, and more Americans that typically were not investing in stocks prior to the 20s want to get into the craze. I sort of think of this as tantamount to this sort of Bitcoin NFT craze that's happening today. Although, frankly, that is something that I truly don't fully understand. But I do think that that boom is quite interesting, and how it's literally becoming trendy. And also that the prices of these commodities are not very stable, and further, not regulated by the government. Okay, so there's a comparison there. Between 1925 and 1929, stock prices went from 27 billion to 87 billion. And also, there was a general increase in working wages since World War I, more than a 40% increase on average. And so that extra income might encourage more working Americans to invest in some of their income. Unemployment was quite low during the 20s. In urban America, at least, it hovered around 4%. And generally, again, there's this feeling that anyone can be rich. There's also an increase in just the embracing of welfare capitalism. And this is because of the improvement of working conditions. And it also did contribute to the decline in union membership. And in case you're not familiar with what welfare capitalism is, it's generally the sense that employers can provide benefits directly to their workers, like paid vacations and health plans, and that would decrease the necessity of belonging to a union. And that also, the goal of that from the employer's perspective was to strengthen loyalty to the company and increase worker morale. And a big question for us now is, does welfare capitalism still exist in some industries? To what extent is there still a continuing resistance among some large corporations for workers to unionize? So always think about continuity and change when we're considering all this material. So without going into too much detail, just generally, just a few more things that are interesting here. There's a huge gap still between the rich and the poor. So I'm not saying that everyone in the United States is getting rich. Still in the 20s, 0.1% of the richest Americans held about 34% of the country's savings. Poor families still very much struggled to just maintain a savings, and almost every family member in the working class sector probably had to work to get by, including women. So clearly, this is not a boom for everyone. There's, again, a growth of large corporations at the expense of small businesses. The sort of trust-busting era of the progressive era is over. There's an increase in personal debt, more and more Americans are buying items on credit. That sense of buy now and pay later very much is fueling increase in spending and increase in debt. People assume that they're going to make that money back to pay it back, and that includes buying stocks. So there's a growth, like I said, in stock speculation. But what actually does that mean? More and more Americans are making high risk investments, and they believe that that investment will double or more. And therefore, they can literally, in their mind, borrow money in order to buy stocks. In fact, they could do something called buying on margin. And what that means is that investors only had to pay a fraction of the price of their shares to actually buy them. And typically, I don't know if they were called brokers back then, but typically you would borrow money from a middleman, for lack of a better phrase, and they would pay for the rest. But the assumption was that you would pay them back in full. And this doesn't happen after the crash of 29. There's also quite a bit of overproduction, overstocked warehouses. There were too many cars because by the mid to late 20s, most Americans who could afford a car already owned one, and they weren't in the market to buy a new one. And so that also leads to a decline in the automotive and construction industries. So again, even urban America is experiencing some signs of weakness here. So I failed to talk about the crash itself, but generally, I don't even emphasize it that much in my class, quite frankly. I could add some resources here. The graph in many ways speaks for itself. So ultimately, in early October of 1929, you see rapid plummeting. There was a Black Tuesday and a Black Thursday. It was Black Thursday ultimately where you see the greatest drop in such a short period of time that leads to a panic, right? Investors start to rapidly sell their stocks. Banks begin to fail. And what this leads to is often civilians, people who invested their life savings in the bank. They panic and they try to withdraw their savings before it disappears. But unfortunately, banks start to close before many Americans can gain their savings back. And the reason why that happens is that banks were fairly freely issuing loans to speculators, particularly land speculators. Again, the assumption was that that money would be paid back because of economic growth. But ultimately, what happens is that these banks overextended themselves and they don't actually have the reserve funds to pay back loans when people try to withdraw all of their money. And because these banks fail, we also see widespread effects on what we call Main Street, right? As opposed to Wall Street. Unemployment hovered around 1/4, 1/3 at the peak of the Great Depression in 1932, 1933. And during the Hoover administration, Hoover didn't do much. And one of the reasons why he didn't do much was because he believed, again, in the free market model of regulating the economy. And in that sense, really little to no regulation of the economy. The idea was let the economy just handle itself. If you ever have studied Adam Smith, his book ultimately made the argument that if there was no intervention in the economy, he referred to it as the invisible hand, literally sort of this, the economy itself is doing the regulation and the government should stay out of it. Yes, there will be boom and bust cycles, but ultimately the problem will fix itself. But because, again, this is not just about money, this is about human behavior. When people start to panic, then it's only going to get worse. So I, again, want you to kind of hammer it in that it's not solely about causes of the Great Depression, it's also about symptoms of the Great Depression. So briefly, how does Hoover attempt to respond to all of this? Well, the first thing he tries to do is he established, or it's not even Hoover, it's actually Congress as well that's attempting to make something happen in order to mediate the effects of the Great Depression. And ultimately, one accomplishment, at least that they attempt to do, is they try to pass a tariff. They're attempting to protect American industry. And this was called the Hawley-Smoot tariff, but it backfires because the Great Depression is global. And in many other countries, particularly in Western Europe, they also issue their own tariffs to protect their own economies. And so it leads to sort of tariff wars. And this is going to fail to ultimately do much at all to fix the economy, to make it more stable. Another thing that occurred was that the federal government created something called the Reconstruction Finance Corporation. And what that did was it tried to help stabilize the banking industry. It issued loans to banks and railroads and also mortgage associations and some other large businesses. And again, it was meant to restore confidence and help people put their money back in the banks, but it was not any sort of relief or aid directly to people. And so it didn't really do much to alleviate unemployment. It didn't really do much to put money back in Americans' pockets. And so ultimately, that did not do much either. So, as you could probably surmise, Americans are increasingly losing hope in Hoover's ability to respond. We see an increase in homelessness. You see these people waiting in line just to get food. You also see the cropping up of shanty towns called Hoovervilles. I have them in some of my other slides. But they're called Hoovervilles, of course, because they were blamed on the president. Now, one other thing, I just realized my slide is out of order, so forgive me. This is not normally try to make these videos more polished, but I do think the bonus army is really important to talk about, and then we'll close up. So the bonus army, what this ultimately was a group of World War I veterans who were promised a bonus, like a stimulus, to thank them ultimately for their service in World War I. The problem was that that bonus wasn't due to be paid out until 1945. And so veterans decide to, a group of them at least, decide to march on Washington, D.C. to demand this bonus from Congress and also to draw attention to the public. But the federal government really didn't want or didn't really have that money even to loan out to give rather to these veterans. And so this protesting continues, and ultimately what this leads to is the National Guard itself. It is sent by the Hoover administration, and what they end up doing is having a quite violent confrontation with these veterans. In fact, two of them were shot and killed by the police. And Hoover ultimately expels these veterans from Washington. Some of the camps that they set up were set on fire. And all of this ends up making the national news. So you can probably understand why. In that same year, 1932, that's when this march occurred, it's an election year. And when we talk in the next video about Franklin Delano Roosevelt, we'll have a better understanding of why he won in a landslide. So again, just going back, I'll leave a link to that video, by the way, because it's pretty interesting to watch. But just going back to our guiding questions, here they are. And I hope that these helped you further understand what leads to the Great Depression. And then we'll pick back up with what happens when FDR is elected. Okay, thanks so much, and I'll see you later.